Assalamualaikum warahmatullahi wabarakatuh. In this video, we are going to compare the financial analysis between Seng Industries Berhad and Kawan Food Industries Berhad. We construct a financial analysis for both companies to determine managerial or environmental factors that cause the trend of the firm's financial performance. Both companies were chosen in the consumer product and services sector and have financial year ended on 31st December 2018. In this section, we would like to describe the background of these two companies. Berhad was established on 4th October 1991. Same goes with Huatai Industries Berhad. Seng is also one of the leading biscuits manufacturer in Malaysia. The biscuits manufacturer is operated in kawasan perindustrian Tongkang Pecah Batu Pahat, Johor. On 2nd November 2000, the company has been listed on the main board of Bursa Malaysia Securities Berhad under consumer product industry. The company's mission is to produce quality fast-moving consumer products, and the vision is to be market leaders in fast-moving consumer products. Seng Industries Berhad also is an investment holding company in which its subsidiary companies engage in the manufacture and sale of biscuits and confectionery food items. Kawan Food Berhad was incorporated by mid-1980 and was later listed on second board of Bursa Malaysia. Kawan Food Berhad is one of the Malaysia's leading exporter and largest manufacturer of frozen Asian food delicacies worldwide. It all started more than 40 years ago at a modest family-run business that made and sold homemade traditional pastries to local groceries and supermarkets. The founders took a great pride in work, baking and packing food with love and care.
For the first one, to measure financial ratio analysis is profitability ratio. Profitability ratio shows a company overall efficiency and performance. It analyzes the ability of the company to generate adequate profit from use of the firm's capital and asset. It also used to examine how well the company operating or how well the current performance compares to both the biscuit company. The first type of profitability ratio is gross profit margin, which shows how to measure how much the company earns from its revenue less than cost of goods sold. The data above shows from every 1 ringgit of revenue earned by Seng Berhad, it has earned 0.3571 ringgit of gross profit to cover its operating expense after providing its cost of sales. Then, for every 1 ringgit revenue earned by Kawan Food Berhad, it has earned 0.3971 of gross profit to cover its operating expense after providing its cost of sales. The gross profit for Kawan Food is higher than Seng Berhad, means that the Kawan Food company gain higher earning from its revenue. Therefore, Kawan Food Berhad is better than Seng Berhad in earning from its revenue. The second type of profitability ratio is operating profit margin, which measure how much a firm earns from its revenue less operating expense. Based on our calculation, we can say that from every 1 ringgit revenue earned by Seng Berhad, the revenue is enough to cover up to 0.8166 ringgit of the firm's total operating expense. Then, for every 1 ringgit of revenue earned by Kawan Food Berhad, the revenue is enough to cover up to 0.7393 ringgit of the firm's total operating expense. The smaller the operating profit margin, the easier the management to cover up the operating expense. Therefore, Seng Berhad is better than Kawan Food Berhad in covering the operating expense. Next, the third type of profitability ratio is net profit margin, which used to measure the profit of the firm before corporation tax or after allowing corporate tax. For every 1 ringgit of revenue that Seng Berhad earns, it earns net profit before tax of 0.1879 or a net profit of 0.139 ringgit %. after corporate tax. For every 1 ringgit revenue that Kawan Food Berhad earns, it earns a net profit before tax of 0.1462 ringgit or a net profit of 0.1140 ringgit after corporate tax. The higher the profit margin, the bigger the amount of revenue that remains in the form for distribution to the shareholder or as dividends or for investment in the firm by management. Therefore, Seng Berhad is better than Kawan Food Berhad in remaining the revenue for the distribution or the investment. In conclusion, therefore, in profitability ratio aspect, from the gross profit margin calculation, we can say that Kawan Food Berhad is a good company at creating product and providing service because it has higher profit margin, gross profit margin compared to its competitor, Seng Berhad, which means it has very adequate gross profit margin to pay for its operating expense and good in controlling its stock and manufacturing product. But Kawan Food Berhad has a lower operating profit margin and net profit margin than Seng Berhad, which indicate that these companies are not well equipped to pay for fixed costs and interest in obligation and may be as a problem to survive when economy slow down. This shows that ability of the Kawan Food Berhad to control the distribution, administrative and other operating expense is less efficient compared to Seng Berhad. For Seng Berhad, it has lower gross profit margin, which shows that it has high cost of goods sold, which can be attributed to adverse purchasing policies, lower selling price, low sales, stiff market competition, or wrong sales promotion policies. But it has higher operating profit margin and net profit margin compared to its competitor Kawan Food Berhad, which indicate that this company is more well equipped to pay for fixed costs and interest in obligation, have better chance to survive in economic slowdown, and are more capable of offering lower price than competitors that have a lower profit margin. The higher net profit margins are the better for any company. Means that Seng Berhad is a company that able to control its cost to buy goods and services at price remarkably higher than it costs to produce or provide them.
Now we go to the next part, which is liquidity ratio. Liquidity means the ability of a firm to convert its current assets into cash to pay its current liabilities. Okay, firstly, we can compare by using current ratio. Current ratio measures the firm's assets and compare to the firm's short liabilities. Based on the calculation that we made, the current ratio of Seng Industries is 2.19, while Kawan Food is 3.44. This shows that Kawan Food has more resources compared to Seng to finance its short-term liabilities. Next, we can use acid test ratio to measure the liquidity of a firm. Acid test ratio measures ratio of current assets less stock to current liabilities. Based on the calculation, Seng ratio is 1.83 compared to Kawan Food, which is 2.80. This indicates that Kawan Food has greater ability to use its assets to extinguish or retire its current liabilities immediately. We can measure liquidity using inventory turnover ratio. This inventory turnover ratio indicates that the liquidity of stocks sold and replaced in a year. So, from our calculation, we can see that Seng needs 46.94 days to sell its inventory and replenish it 7.76 times in a year, while Kawan Food needs 71.04 days to sell its stock and take average 5.14 times to replenish in a year. This shows that Seng has high demand from customers, thus leads to strong sales and revenue. Account receivables turnover ratio can also measure firm's liquidity. It indicates how long it takes for a firm to collect its receivables. From the ratio analysis, we can see that Seng average collecting receivables is 8.74 times, which takes 41.76 days a year, while Kawan Food has average of 3.79 times to collect its receivables, which similar to 96.34 days in a year. So, this shows that Seng has more efficient policy in collecting their firm's receivables. Last but not least, we also can use account payable turnover ratio to calculate firm's liquidity, as it measures how long a firm takes to pay its creditors. For Seng Industries, account payable being settled is 4.01 times, which takes 91.09 days in a year, while Kawan Food settled its account payable on average 3.71 times, which takes 98.25 days in a year to pay its trade creditors. This also indicates that Seng is able to pay its creditors without any problems and also in shorter time.
For the next financial ratio analysis is leverage ratio. This section seeks to investigate how a firm is being financed and provide indicators to a firm able to meet interest payments. First is a debt ratio. The debt ratio is defined as ratio of a total debt to total asset. A ratio less than 1 means that the firm has more assets than liabilities. Based on the figure, you can see that Kawan Food Berhad debt ratio shows that it is lower than Seng Industries Berhad as much as 18.36%. Second is the debt equity ratio. The debt equity ratio is calculated by dividing a company's total liabilities by its shareholders' equity. From the table, the proportion of equity and liabilities of Kawan Food Berhad is larger than its competitor. It implies for every 1 ringgit of its equity, it is able to pay 6 cents of its long-term debt. Seng Industries Berhad was able to settle down its long-term debt too, but only had the ability to pay 4 cents for every 1 ringgit of its equity, which is 2 cents less than Kawan Food Berhad standard. Third is interest cover ratio, which is used to determine how easily a company can pay their interest expense on outstanding debt. From the table, Kawan Food Berhad's interest cover ratio is 126.69 times. It means that the company could pay its outstanding debt based on their earnings. For Seng Industries Berhad, they does not have stated the interest expense because they don't have long-term liability. It is because the company established a long time ago. As a conclusion, Seng Industries Berhad is a company that has advantage in financing because they don't have long-term liabilities. They also have more experience to manage the asset of the company because they can use their equity to operate their business.
Now we are going to proceed to another measurement of financial ratio analysis, which is efficiency ratio. Now listen to this very carefully, as efficiency ratio very important for us to measure the company ability to earn sufficient earnings and returns to its investor. Okay, altogether there are 4 sub-ratios that have been discussed, which is earning per share, return on capital employed, return on asset, and last but not least, return on equity. So the first ratio is earning per share. This ratio is used to measure the worthiness of an investment. Let's say if someone wants to invest into an unknown company, he or she can use this calculation to know how worthy of its investment. So to calculate this, we need to know its earning attributable to ordinary shareholder and number of ordinary share issue. After calculate this formula, we will get the earning per share of a company. For Seng, its earning per share is 53.69%, whereby for Kawan Food, its earning per share held
is only 12.68 cents. This indicates for every one ordinary shareholders will get that amount of income of its investment. Therefore, from our calculation, Seng made a higher amount of profit from every outstanding shareholder compared to Kawan Food. The higher the earning per share, the higher the profitability of the company, and it means more profit has earned to distribute to shareholders. Next, we are going to the second ratio, which is return on capital employed. For your information, this ratio measures a company's profitability and the efficiency with which its capital is used. In other words, this ratio measures how well a company is generating profits from its capital. From the figure above, Seng had more earning return compared to Kawan Food. For every Rm1 ringgit of funding provided to the management of Seng, the company able to earn a return of Rm 0.365 cent, while Kawan Food only able to earn Rm 0.0873%. This is calculated by knowing its earning before interest and tax, and another one is capital employed. Other measurement that can be used is by calculating return of asset. So basically, return of asset measure on how efficient the company to generate incomes by using its asset. Again, from our calculation, Seng show a better return of incomes than Kawan Food. Seng is able to generate by Rm 0.1816 cents, while Kawan Food only able to generate Rm 0.0605 cents. For the last measurement we use is by calculating return on equity. This return on equity ratio, or we call ROE, is a profitability ratio that measures the ability of the firm to generate profits from its shareholders' investments in the company. In this case, Kawan Food Berhad had shown a lower effectivity in converting shareholders' fund and investment into a form of profits when compared to Seng Industry Berhad. By 20.05% higher, Seng Industry stays one step ahead than Kawan Food Berhad.
Okay, in order to decide which the best company that is worth to invest in the future, our team had gone through some discussion. First of all, using ratios for analysis is a very useful tool to analyze a firm's financial position. Based on the ratios that have been calculated, it shows that Seng Industries Berhad is likely to have better future in general financial condition rather than Kawan Food Berhad. This is because Seng had beyond Kawan Food in many areas. Seng Industries Berhad is performing well in generating earnings, which can be a good conductor for the future financial performance. Besides that, Seng Industries also sells their stock of goods in shorter time because of high demand from the customers, which may lead to stronger sales in the future. Although Kawan Food is a good company at creating product and providing service because it has higher gross profit margin compared to Seng, but it has a lower operating profit margin and net profit margin than Seng Berhad, which indicate that these companies are not well equipped to pay for fixed costs and interest in obligation, and maybe has problem to survive when economy slow down in the future.
As you can see from the analysis that has been done, Seng Industries Berhad has an advantage in terms of generating future returns. They have the ability to grow more the company to raise profit. They also have no interest expense, which can make some company have a debt. With that, Seng Industries Berhad has a low risk in the long term. Moreover, Seng Industries Berhad is the company that efficient in assets and liabilities, so they will use the shareholders' money to make profit efficiently. However, Kawan Food Berhad can lower their leverage ratio by reduce its margins.
So therefore, from the data explained above, it is wise for the board of the directors to invest at Seng Industry Berhad. As discussed, Seng Industry Berhad had so many advantages in many areas, such as better net profit margin, a comparable turnover ratio, its earning per share, debit equity ratio, and many more. As an investor, we will definitely choose a firm with a better return of investment. After discovering and considering each and every benefit and setbacks for both companies respectively, it is all agreed that Seng Industries Berhad is the best choice for the investment platform. It has a brighter opportunity and lesser threats to the potential investors compared to its business rival.